If you think you might inherit some money from your parents or from an aunt or an uncle or a friend, or if your goal is to pass some funds down, an inheritance down to your children or other beneficiaries, guess what? Depending on what type of account it's in, there could be tax on those accounts. And so today we're going to talk all about taxes on inheritance, when you may be subject to tax, when you may not be subject to tax, and then strategies, again, to help you reduce that tax if you're inheriting or if you're passing it down to others.
Welcome to the Your Life, Your Money podcast with Scott Sierens, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and your taxes. And today, specifically, we're going to talk about taxes on inheritance. My name's Scott Sierens. I'm your host. Also, my goal is to help you thrive in life, wealth, and retirement. As I mentioned, today we're going to talk about taxes on inheritance. I had a client recently asked, will my kids have to pay any taxes on their inheritance? And it brought up some, really interesting thoughts, because this not only applies to, money that you're passing on, but you might have parents that are older than you, and you might be inheriting something from them. It could be property, it could be an IRA, a 401k, a Roth IRA, maybe they have a brokerage account, checking account, savings account, CD account. I can go on and on here, folks. So as you can see, this kind of applies both ways. Not only what you might be receiving, but what you might be passing on. And so I thought it would just be a really good subject to chat about. And we'll talk about taxes on inheritance or on different accounts that get inherited. And so you can put yourself in the situation as the person giving or the person receiving to understand what you might face from a tax standpoint. And I know you might have heard out there that the federal estate tax, the exclusion is, millions and millions of dollars, over 12 million. I'll talk about that in a second. But don't zone out. A lot of times people can think, well, I heard that our estate doesn't meet the those tax. We don't go over that tax exclusion or that value exclusion, so therefore I don't have any taxes on the accounts that I'm inheriting. And actually, that could be wrong. You could actually have tax on the accounts that you're inheriting. So follow along and stick around, because you're going to learn a lot in regards to all of the different accounts. So also, today's just talking about things from a federal standpoint, not necessarily a state standpoint. Each state has different laws when it comes to estate taxes and inheritance tax. And so make sure you check with your state in regards to those specific laws and rules and what they are going to tax. So today we're just going to talk from a federal standpoint. Now, there's a few different things, as I had mentioned earlier. There's the federal estate tax, and then there's tax that you might have to pay on different accounts that you're actually inheriting. And that's where it can get confusing, because one, you might say, I'm under the exclusion, but the other, you still might have tax that you owe or need to pay. So let's just start with the federal estate tax. And just so everybody's got the 2023 limits here, in 2023, the federal estate tax applies only if the assets of the deceased are worth $12.92 million or more. And that's the exclusion for one person. So $12.92 million or under, and you don't have federal estate tax, $12.92 million or more, and you would have federal estate tax. Now, spouse to spouse, that's not counted. There's what they call is unlimited marital deduction. Again, spouse to spouse, nothing to worry about there. It's when it goes from the spouses to other beneficiaries. And then something to know here is Congress can always change this. This actually went way up with the Tax Cuts and Jobs Act. Before that, I think it was down around 3, 4, or 5 million, something around there. And so it really almost doubled itself with the Tax Cuts and Jobs Act in 2017. And so keep in mind, Congress can always change that. That's something that they can reduce to, tax more of what people are passing on to their beneficiaries. So keep in mind that can go up, but it also can go down. And the other part, as I had mentioned, that $12.92 million, that's a an exclusion for a single. So a couple, if you're married, you've got the exclusion of $25.84 million. And again, as I had mentioned earlier, if you're hearing this, don't turn off the channel, right? Don't turn off the radio. Don't turn off the podcast, because there are accounts that you could be inheriting or giving to your beneficiaries that will get taxed. So stick around for that. But I did want to cover the federal estate tax first, just so everybody was well aware of what that means. Now, what counts towards the federal estate tax? Well, according to the IRS website, and I'll put some different links here in the show notes. Again, you can go to lifemoneyshow.com. That's lifemoneyshow.com. Click on the show notes to get the links that I'm referencing. From the IRS website, it talks about the estate tax is the tax on the right to transfer property. So when you think about that, what counts towards the estate tax? Anything that you would consider property. Just some examples would be your cash, your securities, which would mean your investments, real estate. It could mean insurance, trust, annuities, any interest that you might have in any businesses, and the list goes on and on. As long as you consider it property, as long as you've got ownership in the item, well, then that could be all counted towards that federal estate tax. Now, as I had mentioned, if you're not passing these amounts on, or if you're not receiving these amounts, does that mean that you're not paying tax? Well, no, it doesn't. Actually, you could be potentially paying tax on some of the different accounts that you're going to be receiving or be passing down to the others. So now let's talk about the typical assets that you might inherit or that you might be passing down. And the typical ones that come to my mind that might be on your mind as well could be real estate, IRAs, 401ks, 403bs. What about those brokerage accounts, checking, savings, money market accounts? And then how about those Roth accounts as well? So that's what our focus is going to be for the next portion here as we go through. So then that way you can relate to what might be going on in your life. If you've got parents that are older than you that may be passing something down, or if you're passing something down to others and wondering how will that get taxed. So as I mentioned earlier, spouse to spouse, not really covering that in today's show. A lot of stuff will go spouse to spouse, no problems with potentially and most likely without any sort of tax. But what we're really talking about is that if you were to inherit something, let's say from your parents or from somebody that's not your spouse, or be passing down to your children or to other beneficiaries. So where should we start? Well, let's start with real estate. Maybe you own your house or you own property. From a real estate standpoint, there's actually some really helpful tax laws, and it's called the step up in cost basis. And we've talked about this in a few times before on the show, but let me just walk through an example. Let's say you're inheriting real estate from your parents. Now, your parents, let's say they bought the piece of property. I'm just using easy numbers here today. They bought the piece of property at $300,000. Since they purchased the piece of property, it's gone up in value to $500,000. When they passed away, what happens is called this step up in cost basis, meaning the value of that property is now $500,000, and that's also the value that it gets inherited at and now considered the new cost basis. You see, if your parents would have sold that property right before they passed away, it would have went from $300,000 to $500,000. That's $200,000 of gains. Let's say it's a rental property. Well, in that instance, to those $200,000 of gains, that would be taxable gains. Now, let's say instead they pass away, you inherit it at that $500,000. The $500,000 is your new basis. So if you were to sell it right away, you inherited it at $500,000, you sell it at $500,000, you actually have zero gain. See, it does not, now that you've inherited that piece of property, it doesn't go back to the $300,000 that your parents initially purchased it at. It goes up to that new cost basis of $500,000. So if you sell it right away, well, there you go. You sold it at the value you inherited it at. You don't have any sort of tax on inheriting that property. However, if you were to hold on to it, Well, that's where taxes could come into play. Let's say you don't move into the property. It was your parents' property. You inherit it now at the $500,000. They purchased it at $300,000. You inherit it at $500,000. That's your new cost basis. But you don't sell it right away. You're like, I'm going to try renting it out or something else, and so you hold on to it. Well, now taxes could come into play. Let's just say you decide to hold on to it for 9 months. You try renting it out or something, and you're like, yeah, this isn't for me. I want to go ahead and sell it. Well, let's say over that 9 months, it goes from $500,000 to $550,000. Guess what? You're going to owe taxes on that $50,000. And since you held it for less than 1 year, now you're subject to short-term capital gains, which is the ordinary income tax rate. Let's say instead you hold it for at least 1 year. So you go from $500,000, and a year and 3 months, you're like, you know what, still don't want to do this rental thing, and you decide to sell it, and it appreciated now at $575,000. Well, you've got $75,000 of gains, but since those gains are over 1 year, you held on to the piece of property for over 1 year, you're now looking at long-term capital gains. Long-term capital gains are at a more favorable rate. If you don't think you're going to do anything with the property, I guess, one of my recommendations would be maybe then just sell it right away. That way you don't have to worry about any sort of taxes when it comes to the piece of property. You might have to, but it'd be like very small, right? Because you held on to it for a month or something like that before you decided to sell it. But when you start holding on to it longer than that, now you could be looking at tax on that property. And there's nothing wrong with that, right? So you made $75,000, you pay tax on it. But was that really where you were hoping to have that $500,000 working for you? Or did you want to put it somewhere else? Were you going to hold on, put it somewhere, invest it, and hold on to it for a long term from that standpoint there? So it all depends on what you're trying to look to do with your money and investing it, or that property, and investing the value of what you own there. So that's from a property standpoint. My only recommendations there is that if you don't plan on holding it, you need those funds for something else, then maybe I'd look at, selling that piece of property right away. So taxes in that instance are minimum. So see, already here, the federal estate tax might not apply to you, but taxes on real estate, taxes on your IRA, 401k that you're inheriting definitely could. So let's move into that next. Let's just say you're inheriting a 401k, IRA, 403b, 457. I mean, those are the typical accounts that people have been saving into for a lifetime when it comes to their retirement. So a lot of those types of accounts are going to be passed down to beneficiaries. Well, guess what? Those accounts, when you put into it for your own retirement, when your parents put into it for their retirement, they didn't pay any income tax on those accounts. And yes, the IRS, they want their income tax dollars back. So what does that mean? Well, that you're going to have to pay income tax on withdrawals from those accounts. First off, let's talk about some strategies here. One is I want to make sure you inherit this. I want to help make sure that you inherit this money properly. One of the things that you want to do is you want to open up what's called a beneficiary IRA. Again, that's a beneficiary IRA. It allows you to roll when somebody has an IRA, 401k, 403b, 457 that they're passing down to you. It allows you to inherit that without paying any sort of income tax on the lump sum that you're inheriting. Then once you've inherited it, you've got it now in your beneficiary IRA, there's some rules that apply. Also, Congress recently passed what's called the 10-year rule, meaning that you have to take those funds out over 10 years. So from the day that you inherit the account, you've got 10 years to empty the account. Why do you think that? Well, again, the IRS, they want their money out of that account. So guess what? Over those 10 years, while you have to get all of the money out of that account, now you're going to pay income tax on every dollar that takes out. One of the things out there, and again, we're recording this in 2023, that's something that's still out there is whether or not you have to take required distributions each and every year from the account. I'm going to say talk to your financial professional, talk to your tax professional. The IRS keeps going back and forth with rules on that. But one thing that's really clear from the IRS is that you do have to take all of the funds out of that account within 10 years. There's some rules that apply based on age and things like that, but probably for our audience, for the most people listening to this, you probably have to take money out of that account in 10 years. So think about the impacts that 10-year rule could have. Let's just say there's $1 million in the account and there's one person that inherits it. Well, that's $1 million that you have to now take out over 10 years. If you're doing it all at once, that could be $100,000 a year of taxable income that you now have to add on top of the taxable income that you're already taking out. So think about that. See, this is how now inheriting an IRA, inheriting a 401k, you might think that, okay, well, I'll pass that on to somebody else and, I've got it tax deferred. It'll be a good account to pass on. Let's just say the person inheriting it is at a tax bracket higher than you. They make more income than you. Well, guess what? Now when they're taking that money out, forced again to take out over 10 years, they're taking that money out at a higher tax bracket than you are. So to this person's question that kind of went and created this whole podcast, he said, hey, will my children have to pay any taxes on their inheritance? And he's got a large sum actually sitting in his IRA, multiple millions of dollars. Well, and he only has a couple children. They're doing very, very well in their careers, where they're sitting in the upper 20% tax brackets or the 30% tax brackets. So we looked at it and we said, okay, well, you're in a situation where you might be in the lower 20% tax bracket, your children upper 20%, 30%, and we started doing the math, right? Okay, here's how much they would get, divide that over 10 years, here's how much they'd have to take per year, because they're still in their working years, so it's not like they're going to have years where they just have zero income because they retired. And so we looked at it, and by passing that on to his children, they would actually pay more in taxes on that amount or on that money than he would. And it was important that they pass that money on to their children. So one of the things in that situation that's being considered and potentially looked at are Roth conversions. So they're taking and paying tax on that money today at their tax rates. So then what gets passed down is potentially a Roth IRA bucket, which is growing tax-free, gets passed down tax-free. We'll talk about that in a second. But see, you can look at that as like family tax bracket management, because the parents now are paying tax at their rate, which is a lower rate than the children's tax. Again, trying to keep more with the family versus giving it to the IRS. Now, some alternative solutions that we've looked at too is I've had clients where they are inheriting from their parents. They're, when they're, let's just say 60. I've got one client I'm thinking about here. They're 60. They just inherited money from their mother. Well, one of the things that we're considering is that we're going to kind of keep pushing off what they have to take out, because then once they retire, you see, we'll use this as their income. So they'll retire, they'll no longer have their employment income coming in, we'll keep their income low, and now they take this inheritance, this beneficiary IRA withdrawal, again, following those 10-year rules, once they've retired at a lower income at a lower income tax bracket, tax rate. So kind of went into the weeds there a little bit, but I wanted just to share with you a few stories that, if you're inheriting an IRA or 401k let's just start with this. If you're inheriting one, you might really want to consider timing of your withdrawals based on your situation, when you might be retiring, when you might have lower income tax years, to try to minimize its impacts, because you are going to have to pay tax on every dollar that comes out. If you're planning to pass on an IRA or 401k, then what you might want to be considering is family tax bracket management. Hopefully I've ran you kind of through some stories that help you understand why you might want to think about that. Some strategies here, if you are the one giving and passing down that inheritance, is Roth conversions or qualified charitable distributions. If you are the person inheriting, as I mentioned, really putting together a tax plan to understand when it's best for you to take that income on following that 10-year tax rule. So Hey, hopefully you're finding this of value and benefit so far. And if you're listening, I'm certain that taxes are on your mind. And if so, we've got a free guide to unlocking hidden tax opportunities. It's going to give you an actionable advice specific to your situation and a checklist to utilize, again, to help you unlock hidden tax savings opportunities that might be available to you that you are unaware of, helping you keep more of your hard-earned income and your hard-earned retirement savings in your accounts versus giving it to the IRS. If you'd like the free guide, you can go to lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes. All right, with that then, let's talk about a few more accounts that you could potentially inherit. So the first one that we already talked about IRAs, 401ks. Now let's talk about the Roth IRA, the Roth 401k, the Roth 403b. Say you're to inherit or pass down a Roth. Well, guess what? The money sitting in that bucket is tax-free money. So you get to pass it down tax-free, or if you're the one inheriting it, you're going to receive that money tax-free. Still want to make sure you start that beneficiary Roth IRA. There's rules to follow because you want to keep it in that Roth wrapper, okay? Because that's really important. I'll explain that here in a second. So keeping it in the Roth wrapper, why is that? Well, because there's still the 10-year rule. So let's just kind of walk down two paths. You inherit this Roth IRA. You're like, woohoo, got this tax-free money, and you start taking it all out of the Roth account. Well, you got to put it somewhere. Maybe you're going to spend it. That's fine if you are, if you're going to use it for something. But if you're like, well, I was just going to reinvest it anyway, guess what? Anything that you're going to put it in, unless you're putting it in a Roth, but you can only put so much yourself each and every year into a Roth. So anywhere you're going to put it is most likely going to get be taxable money. So you want to keep it under that Roth wrapper. Now, the IRS, just like the IRA, has the 10-year rule for the Roth IRA. Why? Because they want you to get it out of that tax-free bucket where then they could potentially put some tax on whatever interest or dividends or gains that you might have on it. So you still have to follow that 10-year rule, whether or not there's required minimum distributions. Talk to your tax professional, talk to your financial professional. However, you do get it tax-free in that 10-year rule. If you asked me a strategy, what would I say? Take out the minimum distributions if you have to take those out. But after that, let every penny you can grow all the way to the end of that 10 years until they're forcing you to take that money out of the Roth IRA, because then you're getting 10 more years of tax-free growth on that money. And then at the end of that 10 years, you are going to have to take that money out, in which case you'll have to make those decisions of how and where you're going to want to reinvest that. And so some strategies to think about if you're going to take that out then at the end of that 10 years and you want to try to help avoid taxes as much as possible. One of the things that you would want to do is look at a taxable account and a buy and hold strategy where then your gains are pushed off until you sell any of your investments. So anyways, that's the Roth. Pretty straightforward, but hopefully it helps you understand whether you're passing one down or inheriting one. First off, make sure you inherit it properly. Talk to your a financial professional in regards to that. Don't just take it out and put it in your checking account. Gosh, you'd be missing out on a lot of tax-free gains. But then it is tax-free money. So you can make withdrawals tax-free, but take advantage of that 10-year growth. Okay, our final account today to talk about is the taxable bucket. All of the accounts that sit in that taxable bucket. So that would be your checking, your savings, CDs. Then you've got investment types of accounts that sit in the taxable bucket. So this would be your non-retirement investment accounts, your brokerage accounts, your individual accounts, your joint accounts, trust accounts. All of these instruments get passed on as well. Now, I'm going to kind of divide them into two chunks here. Let's just say checking, savings, CDs. You might have to pay a little bit of tax. Again, if you see when you inherit this money, again, you get the step up in cost basis. These types of accounts really aren't growing. So, let's just say you hold on to these accounts even for a year before you distribute them. Well, they might have grown a few $100 or something at, depending on how much you have in them. They're not growing that much. You just have taxes on any interest, dividends, and gains, but you're not looking at a huge amount of tax here. A lot of these accounts, those are the accounts that we tell people, right away, hey, you just want to distribute these. If you want to keep a small amount in a checking or savings account, to kind of finalize things over the next year, great. But just go ahead and distribute those right away, because that way you're not looking at any sort of taxes on those types of accounts. Now, the other accounts that it might just make sense for you to distribute these right away too would be like the brokerage. So the second grouping here under the taxable bucket would be like the brokerage account, individual investment accounts. Sometimes they're called retail accounts. It could be a joint investment account you have. Maybe it's called a trust account that you have. Those work very similar to real estate. What you get is called a step up in cost basis. So let's just say your parents, you're the person inheriting. Again, you can put yourself in either shoes here. And your parents a long time ago bought Apple, or they bought Facebook, or they bought Microsoft. And they did it while the prices were low. And as we know now, the prices of all those companies are much higher than they were 20 years ago. So there's a lot of gains in their account. Well, if your parents were to sell before they pass away, similar to property, they'd be looking at capital gains taxes. Instead, if they transfer it to you after they pass away, just like real estate, you get what's called the step up in cost basis. So I think in real estate, we're using the example of $300,000 and $500,000 is the value when they passed away. Same thing here. If in Microsoft stock, or just fill in the blank, they've got mutual funds, whatever, and the value when they purchased was $300,000, but the value at their passing was $500,000. Guess what? You inherit that money at the value of $500,000, and that is your new cost basis. And so you get stepped up to that new cost basis. Now, could you then owe tax? Well, similar to real estate again. Hold on to that for a few months, and then you sell. Guess what? If there's gains in those months, then yeah, you could owe tax on that. If you hold on to it for multiple years and then sell, you could owe tax again on the gains from that, in our example here, $500,000 forward. But if you sell right away and distribute the stock, well, again, guess what? You may not have any sort of tax. And same thing if the value goes down. So if it was at $500,000 and the value you hold on for a year and the value of that stock goes down to $450, well, guess what? Each person that would be inheriting would then have losses that they'd be writing off on their taxes. So you could be looking at tax when it comes to those kinds of accounts as well. I hope today's discussion helped, because I think a lot of times people get very nervous as they're inheriting money because they're wondering about how it's going to impact their tax situation. And as you can see, sometimes there could be no impacts, and sometimes there could be larger impacts, especially if you're inheriting an IRA, 401k, 403b, 457. There definitely could be some impacts there, because you're going to have to pay income tax on every dollar that comes out. One thing I didn't mention earlier is you really want to be careful on all of these of how you inherit the money. So here's the example kind of a potentially really big tax mistake. Your parents are passing down to you a $1 million IRA. And you're like, wow, this is great. Let's just take that money and put it into our checking account. Well, guess what? All of that money, as soon as it goes out of the IRA and into your checking account, you now have a $1 million of taxable income going on your tax bill for that year. However, if you did the beneficiary IRA, as I was stating earlier, all of that goes into your beneficiary IRA as a rollover, and it's a non-taxable event. So be very careful, right? Because to take a $1 million distribution, that for sure could push you up into the 30% tax bracket. And right there, next thing you know, 1/3 of it potentially wiped away, versus going the other route where now you can try to minimize the taxes on that inheritance. So hopefully you found today's show around taxes, inheritance, to be of help. Now you've got a guide, whether you know that you might be getting an inheritance down the road, or if you're trying to pass something down to your children or to beneficiaries, thinking about family tax bracket management and how to do that in the most efficient way for the entire family. So, hey, if you enjoyed today's show, don't forget, subscribe on your favorite podcast player. And I look forward to our next conversation of helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.